Good morning, everyone. Delighted to be here. My name is Thomas Erdösi. I'm a senior product manager at CF Benchmarks. CF Benchmarks is essentially a cryptocurrency benchmarks and index provider. We are regulated by the UK FCA, authorized on the UK BMR, and we have a pure play focus on benchmarks and indices linked to digital assets. In a nutshell, what we do is we help raise investor confidence in crypto as an asset class. And we do so by creating a trusted measure of reality, which can then be used in the creation of derivatives, the settlement of those derivatives in particular, and for NAV calculation purposes for ETFs, and so forth. You may have heard of our flagship product, the BRR, the Bitcoin Reference Rate, which to date has settled in excess of $500 billion of CFTC-regulated futures contracts traded on the CME, the Chicago Mercantile Exchange. It has also acted as, or still acts as, nav rail for multiple ETFs around the world. And finally, you may have heard of our digital asset classification structure, the DAX, which serves as a taxonomy for crypto assets and really as a framework for building thematic indices around crypto. So today I'm here to talk to you about the Bitcoin interest rate curve, or the BIRC, as we call it. And it is really the first institutional grade benchmark linked to a interest rate linked to digital assets. And we built it to really become the cornerstone of the crypto ecosystem when it comes to valuation of assets and pricing of derivatives and so forth. Much like the US Treasury curve is the cornerstone of traditional financial markets. And the point of all this is really to push forward global cryptocurrency adoption and to help the industry to evolve and to really unlock Web3 capital. But let's take a step back. Why a Bitcoin interest rate curve? Why an interest rate curve linked to any digital asset? So as part of my role at CF Benchmarks, I try to look around the corner and see what's next for crypto. And I think nobody here would disagree with me when I say that crypto in general is yet to unleash its full potential. So if we look at the crypto total market cap, that includes basically any instrument that is traded in crypto, that stands just around $1 trillion. If we look at the outstanding notionals just in interest rate derivatives in TradFi, that stands at over $500 trillion. So that is obviously an enormous potential when you compare those numbers. And this potential is specific with regards to interest rates and swaps and interest rate derivatives, which we're hoping to build using the BIRC eventually. Now, taking another look at this distribution, we see really that the interest rate derivatives segment in traditional finance dwarfs everything else in the market. So if we look at international equity markets, the market cap is just above $100 trillion. International bond markets stands around $130 trillion with, like I said, interest rate derivatives 4 to 5x that. So that gives you another idea of how the debt market in crypto is far from its potential. Global debt has now surpassed $300 trillion with no real sign of slowing, no real sign of stopping. And the key point here is all of that debt is underpinned by some type of interest rate. So part of that you might have sovereign bonds, corporate bonds, even consumer debt, the credit cards in all of your pockets today. All of that is linked to an interest rate of some kind. That might be fundamentally a Fed funds rate, a Bank of England base rate, Treasury rate. The key point is crypto needs an interest rate to really unlock the full potential of debt markets. Now, okay, so far we have established that we need interest rates to unlock debt markets in general, specifically interest rate markets, which are orders of magnitude larger than its underlying market. But let's have a specific look at the crypto landscape, the lending landscape today. And the problem we have is that crypto lending today is fragmented. Its liquidity is divided between a handful of OTC lenders and DeFi protocols. If we look at the DeFi market in particular, the total value locked, the TVL, today stands around $40 billion US. That's obviously quite a bit lower compared to the peak during the last bull run towards the end of 2021, but has shown good signs of recovery since the beginning of 2023. Now that total TVL, the lending TVL, is largely made up of three protocols. It's Aave, Just Lend, and Compound. That makes up around 80% of today's lending TVL in DeFi. As we will see later, Aave and Compound are key contributors to the Bitcoin interest rate curve. Now, another problem that we face today in DeFi is that there is no real way of knowing whether or not a project or an interest rate linked to a protocol is sustainable. So if your bank calls you today to let you know that your interest rate on your savings account is going up to 100%, that should seriously worry you. I'm sure it would, because we all know what the base rate is, and we know that there's no way that your bank can pay out that kind of interest in the long term without defaulting. Same principle goes for DeFi. So if a project gives you 5%, how do you know if that's risky or safe? What about 20%? How can you really tell? And obviously, there have been numerous sort of case studies in the past over the last 1 to 2 years where DeFi apps are promising, for example, 20% interest on stablecoin deposits. That was the example with Anchor. We all know what happened to its founder. And there are many more examples like this. And the key point is really that if a base rate existed from where things could be priced, it would be much easier for investors to price that sort of relative incremental risk. And obviously, the lack of this has been at the core of some of the defaults or some of the problems we've seen with projects, not just in DeFi, but generally in lending over the last couple of years. And just to bring this point home, that type of interest rate risk is everywhere. So there are numerous protocols paying large interest rates, which on paper are difficult to justify. And the real point of debt and credit markets in general is to pass risk and reward. I mean, that's the core thing that debt markets are supposed to do. And from a user perspective, it's therefore really important to have that base rate to compare to such that you're able to pass the risk. And with that confidence that investors will then have, that will help the ecosystem to grow more sustainably. At the same time, perhaps even more importantly, for protocols and projects, on the lending side, it's even more important to have a benchmark rate. Why? Because it will eventually allow market makers to come in and to provide hedging solutions, which will help to hedge out that benchmark piece. And the lenders will just be left with the counterparty piece. So that is a really key piece, the hedging solutions, the market makers to come in to have that confidence, because the market is mature enough to provide the hedging solutions, to provide the risk management solutions for the market to evolve. So, in summary, without a North Star, capital is less productive. You see speculative bubbles forming due to merciless yield farming, eventually criminal activity. And the main problem is money, good money, stays on the sidelines or is stuck in subsidized protocols instead of financing good sustainable growth, bringing the industry forward. So there's no meaningful benchmark to evaluate lending and borrowing risk, and it's really holding the industry back. So what can we do about it? So in the next section, I'm going to go over some of the methodology and how we came up with the Bitcoin interest rate curve. But before that, I'd like to talk about some of the key properties that any index that CF Benchmarks builds has to live up to. And that's a very, very crucial point. So we try to live by those three objectives. The first one is representativeness. It's a representative of economic reality, meaning the benchmark has to really represent what's physically happening, sort of the transactions that are happening in the markets. Secondly, even more importantly, replicability. So any index, so any daily publication that any of our indices print, they have to be replicable by anyone sitting here. Any investor has to be able to go into the market to trade the underlying instruments and come up with the same number. And finally, resistance to manipulation. This is also a key point. So we build all of our sort of the mathematical framework behind how we calculate, how the methodology is built, has to be resistant to manipulation. So for example, front running is a key sort of term here that we try to avoid the way we set up the methodology. So fundamentally, the BIRC is a measure of the underlying economic reality of borrowing and lending. And what we do is we use outright lending data as well as quotes supplied by a panel of OTC lenders that we have. And then the second point is we imply rates from traded futures contracts, so traded market instruments. So, and this is accomplished by taking into account the executed transactions on exchanges like the CME, Binance, and so forth. Then executed loans on DeFi lending protocols like Aave and Compound, and then the OTC panel that I just mentioned. Crucially, the way we build the methodology and the way this whole framework comes together is that we build the yield curve from the viewpoint of someone who owns Bitcoin. So it's a viewpoint of a Bitcoin holder. And that's quite critical because that allows us to really build a true native Bitcoin interest rate curve, i.e. our interest rate curve is denominated in Bitcoin. So that's a true Bitcoin percentage. So here we see a daily output. That was actually on the 9th of July, so very recently, what the BIRC looked like at the daily print, which is at quarter, so we calculate at 4 p.m. London time. The curve is published 4:15 London time every day. And we see here at the top all the tenors that we publish an interest rate for. So we start at a session rate, which is akin to an overnight rate. Of course, crypto markets don't close. There is no daily close. Therefore, we call it a session rate. Beyond that, we have a 1 week, which goes in weekly intervals out to the 1 month, and then we print it out to the 5-month tenor. Why not longer maturities? That's because we really look at volume and liquidity, and it comes back to the replicability argument. So it's well and good if we have transactions taking place in the 1-year contract trading on the CME. Trade's quite thin today, but there are transactions. However, if it trades very wide and very, very sparsely, it's really not good enough from our point of view to create a robust benchmark behind it. Which is why today we only go out to the 5-month, but in time we will evolve that as the market matures. And we hope to print a curve out to the 1-year, the 5-year, even the 10-year tenor. So in terms of the actual instruments that we use for each bucket on the curve, for the session rate, which is perhaps one of the most complicated, we factor in all the perpetual futures transactions, and we imply a rate from perpetual futures traded in the markets. So that has a 70% weighting when it comes to the calculation of the session rate. Then we look at the DeFi transactions, which make up only about 10% of the calculation, and the OTC lending panel has a 20% weighting. If we go further out along the curve, it's a simple 50-50 weighting between term futures and OTC lenders. So let's dive a bit deeper into the daily calculation and how that actually works. So we see here the 3 streams. In green, we have the perps, the term futures. In blue, the DeFi, and in orange, the OTC lending panel. For the perps, we calculate the daily implied rate by looking at transactions in futures markets between 3 to 4 p.m. London time. We match each executed futures transaction with the corresponding spot price in Bitcoin, which is the CF Bitcoin real-time index. And from there, from that basis, we calculate an implied rate. We partition that full hour's worth of transacted implied rates into 6 partitions. And for each partition, we calculate volume-weighted medians. Why medians? That comes back to the manipulation resistance argument. So that's a very crucial point. And the final implied rate at the end is the average of those volume-weighted medians across those 6 partitions. For the DeFi stream, much the same, except we look at a slightly longer window. Again, that's related to the volume and the liquidity we see in the markets. So we have 8 30-minute partitions. And finally, the OTC lending panel, that's a point-in-time submission. So our lending panel submits their quotes at 4 p.m. London time. The quote is for a standardized loan made up of a 100 Bitcoin loan, fully collateralized, so on a fully collateralized basis. We then, as we always do, we overlay those inputs with some guardrails and some filters. We filter out extreme observations and so forth. Obviously, we're not interested in reproducing any of the problems that we saw with LIBOR and the LIBOR scandal in the past years, so we do that. And then we bring all these rates together to form the Bitcoin interest rate curve. Now here we just have some data, some of the things we look at when we decide whether or not a futures contract should be included in the calculation of the BIRC. So on the left-hand side, we see just a general Bitcoin futures volumes across different exchanges. This is actually quite an interesting chart because those are dollar-denominated volumes. And we see obviously those have come off quite a lot since the peak of the last bull run, as you might expect. However, if you just look at the CME and you look at just physically the physical contracts, the number of contracts traded, you'd actually see that this is going nothing but up. So we're on a pretty good path there. But still, so we consider that data. And on the right-hand side, you also see what some of that Bitcoin futures volume and open interest looks like on any given day on the CME in this example. So we see most of the volume and open interest is concentrated, heavily concentrated in the front contract. That's contract P. We call that the prompt contract. And then quite a bit as well in the prompt +1 contract. So that's the next to expire contract. But then it trails off quite dramatically. And that is kind of the evidence that we see for why we can't include, the P+7 and the P+8 contract at the moment. But this will change over time. And now I'd like to really go into that implied rate calculation piece, which is probably sort of the key point when it comes to the BIRC and the key value add. So how do we calculate the implied rate exactly? Because especially when it comes to perpetual futures as well, many would propose some type of model where you look at some simulation-based calculation, a Monte Carlo of sorts, and you arrive at a model-based rate. That's something we don't do and we don't want to do. And it comes back to the replicability argument. Because a model is good and it's interesting and it's great, but if you can't replicate it, it's worthless to us. So the way we imply rates is via a traditional cash and carry strategy, which, as I mentioned before, it just involves if the market, the futures term structure is in an upward sloping form, we call that a contango mode, then you sell the futures and you buy the spot to capture that basis. But how can you do that? Because you're a Bitcoin owner, you hold Bitcoin. And if you want to trade that basis on the CME doesn't accept Bitcoins to post as collateral. So what you do is you take your Bitcoin and you take out a collateralized loan against dollars. So you get dollars as a loan to collateralize your CME trading account. So you have the dollars, you post a margin on the CME, you trade the futures, you capture the basis. The spot piece you'll actually have to trade somewhere else because as of today, the CME doesn't allow spot trading. But for argument's sake, on all other exchanges, you can both trade the futures and the spot. So you capture that basis. At the end of the trade, so let's say you do that on a 1-month contract. At the end of the month, you basically take out the basis you captured, you pay back the dollar loan to get back your Bitcoin collateral, and you're left with literally the Bitcoin you initially held, the yield on it, and this is really at the core of this calculation. Now, let's have a look at what that output actually looks like over time. This is for the first half of 2023, a simple box plot. And there's a couple of interesting observations here. One is that during the first half of 2023, the curve was mostly inverted. That is good news and bad news. It's good news because we would expect that. We would expect to see that based on what we know on traditional interest rate markets. When a market is stressed, when there is bearish sentiment in the market, a bearish outlook, the curve is usually inverted. We've seen that for much of the first half of 2023 in crypto related to risks related to regulation, the USDC peg. So there are things like that influence this. So that is the reason for the inverted shape. And then the second thing, perhaps more importantly, and this is probably what you're all thinking now, those ranges are pretty wide. So for example, on the session rate, we see that goes up to 25%. Again, good news and bad news. The good news is we see that in traditional financial markets as well. The short end of interest rate curves are always much more volatile than the long end. So that technically makes sense. Why to that magnitude? It's important to remember that interest rate volatility is linked heavily to the volatility of the underlying asset. And we know that Bitcoin trades at around a 50% implied vol, give or take. So it would make sense that the underlying interest rates are more volatile as well. Obviously, that's something we expect to normalize as market matures. And we already see signs of that, of Bitcoin as an asset, the volatility, the realized volatility is coming off. And the realized volatility of our interest curve publications will come off at the same time. Now, okay, we have a BIRC. That's cool. Let's come back to the use cases and to the real value proposition. So what does that actually do for us right now? We're going really from a complete black box for lenders when it comes to setting interest rates. I have conversations with OTC lenders on a daily basis, and they're begging me for a benchmark to really know where they should set their rates. So no more of that. We go to a state of transparency. And we move away from a state of a complete lack of a standard, where each DeFi protocol, each OTC lenders comes up with their own model, with their own rate, to a state where there's consistency. There is a normalized methodology that is publicly available. Everyone, there's no secrets around our calculations. You can go on our website. You will find the methodologies. All the formulas are there. You can replicate it. And perhaps most importantly, we go from having no clarity on risk and running blind to complete clarity on risk and risk management solutions that are now available. So we can start hedging some of that benchmark piece. And this really empowers a whole array of users. So we talked about the DeFi protocols, the OTC lenders, but it goes far beyond that. So we have all the automated market makers, the trading desks. The trading desks need to optimize their market positioning and interest rate risk hedges. The futures and options exchanges, they need to come up with valuations for their assets and particularly pricing of derivatives. And then generally institutions as well, They require the interest rate data for creating portfolio-based decisions and risk management. So it really empowers a variety of stakeholders. And as a last point, I would just like to go into sort of how we distribute some of that data. And this is a really key point for us, because when we started building the Bitcoin interest rate curve, it was always a key requirement that on-chain protocols are able to interface with the data that we're providing. So the smart contracts have to be able to consume that data and have to be able to feed that into the models they use in DeFi. And that's why we partnered with Chainlink, who have been instrumental to help us publish those interest rates on-chain. The way the BIRC is used today is mainly through the Chainlink provided data in DeFi. So DeFi protocols are using the data mainly to calibrate some of the models that are underlying the lending protocols. So without going into too much detail, but under the hood of every lending protocol is a jump model, which essentially decides what the lending rate and the borrowing rate is. And that jump model basically is driven by the utilization rate, so by how much demand there actually is in the lending protocol versus the supply. And our interest rates really help to model or to calibrate some of those jump models to help the DeFi protocols manage the risk. So that's where we are today. What about the future? As next steps, we are already working on the ETH variant of the Bitcoin interest rate curve. That will be heavily reliant on, obviously, staking yield. Staking is very topical at the moment after the Shanghai and the Chapella upgrade earlier this year. Then we're looking at interest rate curves for stable coins. We have already built some stablecoin indices, some interest rate curves. They're actually an input source for our Bitcoin interest rate curve because of the financing element of the implied rate calculation that I mentioned earlier. And then another one is BIRC-based indices. So ETFs that will effectively pay out let's say the 1 month interest rate of our interest rate curve on a rolling basis. We call those the Bitcoin Plus ETFs, which we are working on. And finally, base rate spreads, BIRC against the dollar. That's another thing. So many exciting things to come. So this concludes my presentation. Thank you for your attention, and I'd be happy to answer any questions you might have. Indeed, there is risk associated, so there's counterparty risk associated with any protocol that you deposit with. We have a clear set of rules as to what type of protocols that we choose. So as I showed earlier, there's a myriad of different protocols we could source data from. We choose Aave and Compound very specifically using very specific rules because we have confidence in those protocols long term. And that's something that CFB generally does when we have very clear constituent exchange criteria which define what exchanges we source data from. So that is one way how we manage that risk. Very good question. That was a big topic for us in the development of the index. And we decided that it's not possible to mingle the two, just because from a modeling perspective, they are quite different. The price information that goes into it is different. So we focus purely on USDT-margined contracts. Also because the liquidity, especially in perps on Binance, is heavily centric on USDT. So that's why we focus purely on USDT at the moment. It's fully live. It's printing on our website. So as I said, so the DeFi protocols they're live using this today on chain, and yeah, we publish it on a daily basis on our website. The methodologies are all available on our website. Data is consumable via API in our prod environment. So it's all live today and has been since August last year. So it's not open source, so people have to license the data to consume it. In terms of auditing, we have an oversight committee at CF Benchmarks, which audits some of the changes that we make. So if we make a change to the methodology, then that goes through a committee to decide whether or not that is appropriate. At the same time, if we make a fundamental change to the methodology, we have to go through a process to obviously inform existing clients who are consuming the data to let them know and to opine if that change is acceptable. So that is kind of the process. Yeah, very good point. Thank you for that question. So I'd like to make clear that just the interest rate by itself doesn't necessarily mean that there's a problem with it. However, if you start being able to price that as an incremental risk to a benchmark, that will at least give the investors some idea to how risky that is relative to the other thing. So it will give investors the ability to at least question why is that interest rate what it is. So that is already, I mean, that sounds very trivial, but that is already a huge difference to what we have now. There is no anchor. There is nothing to compare that to. And we do factor this in, obviously. So we look at when we decide which protocols to use to source data from, we look under the hood. We know we don't just filter by the level of percentage. We look, why is that? What are they doing with it? Is there some type of just shady yield farming going on, or is there a fundamental reason with regards to the governance, for example, as you mentioned? So we do look at that. So, thank you. Yeah. So our Bitcoin reference rate, so the BRR, is really our flagship product, and that's where we see most of the volume. So it settles the CME futures, which obviously, as I mentioned, it has settled over $500 billion worth of regulated futures on the CME, and there are around 7 or 8 use cases at this point for the BRR. So the BRR is the key product for us at the moment. But like I said, we built out, so our digital asset classification structure comes straight after. We launched multiple indices related to that, which have live ETFs trading on it. And there is a whole product suite beyond that. The Bitcoin interest rate curve is, like I said, it's being used on DeFi, for DeFi protocols today. I would say, though, that has a much more long-term vision. Like, we are very early doors when it comes to crypto borrowing and lending, and this is really supposed to help that industry grow long-term. So it's, as much as, yes, it's a professional index we produce that we're looking to license, it is also a service to the ecosystem to grow sustainably. I'd love to produce an interest rate curve on Litecoin. It's purely bounded by liquidity and volume, and it comes back to the replicability argument. So as soon as there is enough volume in those contracts, I'll be the first one to look at that data, and we will allocate resources to publishing interest rate curves on that. So we continue observing the markets on a daily basis, not just for our live products. Obviously, that's very important to make sure our live products are valid and stay close to the market, but anything new that we could launch. As of today, it's really Bitcoin and ETH that allow us to really build an institutional grade quality type of interest rate curve, which is what we're after. So that has to heavily surround around the staking yields. So we'd still source all the data from the futures and from DeFi as well, and from our panel of OTC lenders. But the staking yields would really act sort of as a foundational piece, and perhaps sort of as a minimum rate for that piece. So it's all based around staking.
Well, with that, thank you very much, Thomas. Cheers.
Thank you.